Investing in the stock market can be a roller coaster ride, filled with ups and downs that can make even the most seasoned investors nervous. But what if there was a way to reduce your risk and potentially increase your returns? Enter the concept of margin of safety, a powerful investing principle that has been used by some of the most successful investors in history. At its core, margin of safety is about buying stocks at a significant discount to their intrinsic value. It's like finding a designer handbag on clearance. You know it's worth more than the price tag, so you're getting a great deal. But instead of saving a few bucks on a purse, you're potentially setting yourself up for substantial investment gains while limiting your downside risk. The idea is simple. Determine what a company is really worth, its intrinsic value, then only buy the stock if it's trading well below that value. This difference between the intrinsic value and the market price is your margin of safety. Let's say you estimate a company's intrinsic value to be $100 per share, but it's currently trading at $70. That $30 difference is your margin of safety. If you're wrong about the company's value, or if something unexpected happens, you have some cushion before you start losing money on your investment. This concept isn't just about being cheap or looking for bargains. It's a disciplined approach to investing that forces you to think critically about a company's true worth and to be patient in waiting for the right opportunities. One of the beauties of the margin of safety principle is that it can be applied to any investing style or strategy. For example, let's say you're interested in a fast-growing e-commerce company. You've done your research and believe the company could be worth $200 per share in a few years based on its growth prospects. However, due to some short-term challenges, the stock is currently trading at $100. By buying at this price, you're giving yourself a significant margin of safety while still participating in the potential upside. On the flip side, imagine a stable, dividend-paying utility company that you estimate is worth $50 per share. If it's trading at $48, there might not be enough margin of safety to make it an attractive investment, despite its apparent stability. Implementing a margin of safety approach requires discipline and patience. It means being willing to sit on the sidelines when stocks are overvalued and having the courage to buy when others are fearful. This can be challenging, especially during bull markets when it seems like every stock is going up. But remember, the goal isn't just to make money in the short term. It's to protect your capital and generate sustainable returns over the long haul. One way to think about margin of safety is like wearing a seatbelt when you drive. Most of the time, you won't need it. But in those rare instances when something goes wrong, it can be the difference between walking away unscathed and suffering serious harm. Calculating a company's intrinsic value is both an art and a science. It involves analyzing financial statements, understanding the company's competitive position, and making educated guesses about future growth and profitability. There's no one-size-fits-all formula, which is why different investors might come up with different intrinsic values for the same company. Some common methods for estimating intrinsic value include discounted cash flow analysis, which projects a company's future cash flows and discounts them back to present value. Once you've estimated a company's intrinsic value, you need to decide how much of a margin of safety you require before investing. Applying the margin of safety principle can be particularly valuable during market downturns or periods of economic uncertainty. It's important to remember that just because a stock is cheap doesn't mean it's a good investment. That's why thorough research and analysis are crucial. Implementing a margin of safety approach requires emotional discipline. It means being comfortable with missing out on some opportunities and potentially underperforming the market in the short term. Remember, investing is a marathon, not a sprint. The margin of safety principle is about playing the long game, protecting your capital, reducing risk, and positioning yourself for sustainable long-term returns.